Hi, my name is Phong, and today I'm going to talk about market bubbles. Because of the time limit of this assignment, I just want to talk about two of the most influential and well-known bubbles in the history, in my opinion. And the first one is the tulip mania, the first financial bubble. So when it comes to tulip, people often think about the Dutch, and rightfully so. I would even consider tulips a national flower at this point. But the funny thing is, tulip doesn't originally come from Europe. It came from Persia via by trade routes of the Ottomans in the 16th century, and it came with a variety of color, and it quickly became symbol of wealth and luxury. You have to know that at that time the Dutch have a very developed middle class, which are traders and merchants, and they want to show up their wealth to their neighbors. So the tulips are the choice. It's like a fashionable collector item at that time. So among those tulips, there's also a special type which is have above all other, the broken buff. As you can see here, these have dark stripes and flames in the light background. And the interesting thing is this doesn't come from the flower genetics, but rather from a virus. And the field of genetics doesn't exist for another 200 years. So this is extremely random and rare. So as a result, they are crazy expensive. I believe you could even buy a house at that time with one of those tulips. So the tulip mania swept through Holland in 1634, and tulip price just saw as speculation grew. Everybody German and they even buy tulips on credit with the hope that they could sell it for profit for the next person. And the demand for tulip was so large that by 1636, they were even established on stock exchange of Amsterdam in various cities and towns in Holland. But the price just can't go up forever. It has to stop at some point. And the bubble had burst by the end of 1637. The buyer announced they couldn't pay the high price, and the market quickly fell apart. So what's the lesson here? It is to avoid speculative assets disconnected from real value. And when you think about it, tulips are at the end of the day, they're just flowers, which can exist for 1 or 2 months. I mean, I'm not an expert. You can correct me on that, but you know what I mean. It doesn't have any real value at all. So come on to the next bubble, which is the dot-com bubble, the internet revolution. So here's a summary. It was a rise in US technology stock in the late 90s. Before going to the main parts, you have to understand the context of the story. Imagine the years 1995. The internet had just gained popularity. It's become more accessible than ever before. It's like a whole new world, a whole lot of untapped potentials, coupled with the fact that the interest rate for the US at that time was at its lowest since the 70s. Opening a business is as easy as touching grass. So there were a lot of startups, and they have a similarity. They all have .com in their names, and those all experienced skyrocketing valuations, and the capital market just kept throwing money at them uh, without doing any fundamental analysis, like how the company will do, how's their operations, stuff like that. So yeah, tech startups raise billions of dollars through venture capital and initial public offerings. But the thing is, most of these companies spend a fortune on marketing to establish a unique brand among other competitors. But but they didn't use the money on research and development. They did not use it for new products. So the market reached the peak on March 2000 when the Nasdaq hit 5,048 points, which is a crazy 529% jump from 1995, and valuation were inflated far beyond earnings. I believe the number is roughly 200 times beyond the earnings. There's also an interesting event during that time, which is the Y2K bug. It's a calendar bug that threatened to end technology, so people were panicked and they wanted to upgrade their computer components, which is another huge boost for the market. But the collapse come not very long later, when the Federal Reserve in the later uh, 2000, they announced that there will be a modest increase in interest rates, and also people realized that they don't need to upgrade their computers anymore, and investors all began questioning the sustainability of tech companies. And the fact is, those companies, they don't have a single cent of profit, it's all just hype. So a wave of sell-offs caused the Nasdaq to lose 78% of its value by 2002, and high-profile bankruptcy included companies like Webvan and Pets.com, the loss of bankruptcy during this period. And what's the lesson here? It is fundamentals and profitability are crucial for valuations, and just don't invest just by riding off the hype, just by jump on the bandwagon. And please do your due diligence before investing in any companies. Thank you for listening.